Hello, everyone. Good afternoon. Thank you so much for listening to me. Unlike any presentation you've ever seen, I'm going to show you something very unique. Unfortunately for me, it's not results that are going to blow your mind. And in fact, it's actually a quote by John Lennon, which, to the best of my knowledge, is the first time I see one of those things in a finance or eco journal, which is everything will be okay in the end. If it's not okay, it's not the end. And that's kind of like the data troubles we've had with this project so far. So last year, when I came here to the research day, we had already identified a couple of issues with our original data set. And literally, they told us, as they usually do, that they were going to give us the data back in a month. And a month became 9 months. So when Marian actually told me about the current research day, I said, fine. I mean, we were starting to work with the data. And what I presented last time was an amazing thing. So the Brazilian Stock Exchange had promised, and they gave to us, data at the daily level for every single person in Brazil over 2 years, whether it's mutual funds, corporations, and so on. And we thought that, okay, amazing, we'll be able to do all of these studies to test macro papers, the ones that I'm going to show you now that are trying to estimate elasticity. But then as we got the corrected data and started working, we realized that we couldn't use it. So because due to the lack of a centralized share register in Brazil, like the DTCC in the States, which is essentially the clearinghouse that knows exactly who owns shares, what they told us was somewhat true. Even though we had every single investor that traded through them, if you had a shareholder in Brazil, for example, a family owner that never wanted to sell their shares, they wouldn't show up in there. And for what we wanted to do, which was to try to construct the daily portfolios for more than 250,000 different individuals at a daily frequency. That's why the Keynes Fund was so generous to give us the money to rent space here in the supercomputer cluster to run those things. In the end, and we found this out about a month ago, we couldn't use the data. And that's part of the end, and that's the end of the sad story. And what you do? Well, we kept on working, and the Brazilian SEC has data for mutual funds that's also very, very good. It's available at a much higher frequency than what we have in the States. But you see here that we didn't have time to finish the empirical results that I wanted and meant to present to you today. But going back then to the motivation of the project and what we're actually trying to do is, the main question is, how do asset flows move prices? And what's the idea here? If you remember any of our microeconomic models about portfolio choice, usually what happens? Well, the price of anything is equal to the present value of the future cash flows. And even though, like in all economic models, demand is lower if prices are higher, we know that the demand curves, they tend to be very elastic and pretty much flat. And why is that? Well, simply because if we have an exogenous shock that brings in new money to the market, suppose, I don't know, that my grandmother dies, gives me lots and lots of money, and with this extra money, I want to buy stocks. Well, in order for me to buy, someone has to sell, right? So unless there is new information, why would the seller sell it to me unless I give something? So standard asset pricing models, they actually imply an elasticity above 5,000, okay? Which means that the derivative of prices with respect, of quantities with respect to price is really, really tiny, the inverse of this. Okay. Now, there is this very maybe controversial and important stream of papers by Javier Gabe and Ralph Kojin that introduced this idea of inelastic market hypothesis. They actually show that even though on the theory side, the elasticity from the models is super, super high, in practice, when they estimate those things in the real world, they show that this elasticity is in fact very low. In the sense that if we have an inflow into the stock market of about $1, the value of the shares in the market would go up by 5. And the idea here they're proposing is that all these inflows and outflows from the market can explain market movements. Okay, and why should that be the case? Well, if we want to buy $1 of equities, someone has to sell it to us as I mentioned. But we know a bunch of things. One, lots and lots of potential sellers may have investment mandates that prevent them to sell. So for example, if I am a fund that promises to my investors that I'm going to invest 60% in equity and 40% in bonds, if I decide to sell my shares to someone, I would also need to sell my bonds to someone else. So we may have these constraints there. The other potential liquidity absorbers could be hedge funds. But from them, we know two things. One, they are not big enough to absorb big flows. And on top of this, during crisis, for example, rather than providing liquidity to investors that wanted to sell, they're in fact actually buying. And finally, we also know that there's lots and lots of inertia in terms of portfolio choice, especially among retail investors. There are lots and lots of people that they just buy stocks and do nothing afterwards. No matter whether we have the global financial crisis or COVID, they never readjust their portfolio depending on information. And this is why this paper by Javier and Raf tried to motivate this idea of inelastic demand curves. So this might sound very silly, but at least in finance, there are lots and lots of academics that don't believe that this is true. They say, well, this is kind of crap. I mean, prices should be computed just based on information. And there's no way that those transitory shocks can have permanent effects. So this graph here that comes from their paper kind of shows a bunch of different elasticity estimates from empirical papers and then compare to theory models. And here it's important to also make another distinction. We have an elasticity that's called to be a macro elasticity. So for example, how much am I going to change, how many shares I buy in Microsoft if I decide to sell shares in Google? So this is almost like within the stock market, what is the price impact? What we're going to be interested here at first is what we call the macro elasticity, which is essentially is how much our aggregate valuation of stocks will change if we have an inflow from outside, whether it's from bonds, real estate, whatever. So I showed you that quote in the previous slide on how the elasticity is equal to 5,000 for many standard asset pricing models. And this elasticity here is an estimate of the micro one, okay? At the macro level, even when we estimate this using, again, standard models, we find a magnitude for the elasticity that is almost, well, between 20 or 5 to 10 times what a long string of papers have found out using different setups. They looked, for example, at whenever an index changes its composition. Suppose, for example, that the Russell index decides to include or to exclude bad ESG firms. Well, this will lead to an outflow, and then we can measure what is the price impact of that. We can look at mutual fund flows. We can look at international evidence. We have microstructure, formation, and so on. Now, what are we trying to do here? Well, our goal is to do two things. Ultimately, we want, thinking in terms of our data, to decompose the impact of these flows into the stock markets, but by types of investors. Is there a difference in the way by which retail investors, investment funds, corporations react to those inflows? So in a way, we're going to generalize this Gabay and Cogent paper in a multi-asset economy, such that we can estimate macro elasticities. And if you think about the usual way in finance in which the return of any investment is decomposed as a function of some underlying risk factor, so the betas in the finance lingo, we want to be able to do all of that. And what are the research questions here? Well, we're trying to understand, one, how large are the short run and long run impacts of those flows? Standard theory would say that there is no long run impact, everything is transitory. But in the case of inelastic demand curves, that's not the case. I've already mentioned the differences across investor types, but one of the nice things about our data, unlike anything available in the States, is that not only we have what mutual funds are investing from the point of view of stocks, we also have how much they invest in derivatives, fixed income, and so on. So there are a lot of cool things that the current papers cannot do that this Brazilian data can actually address. For example, there are also policy implications for that. if we do see, for example, that by buying some shares, we can really change the value of the stock market. In the same way we have quantitative easing for bonds, another way for us to try to prop up the stock market is to have what? A quantitative easing where we buy directly stocks rather than sovereign bonds. Similar to what Japan did during the financial crisis, where over there, they decided to support directly the stock market through ETFs. And those are kind of the main contributions that we're going to do. We're going to estimate these elasticities then at a much higher frequency than anyone has done before. We're also able to get a much richer variation. Most of the data sets available in the States and elsewhere in the world, they are at the quarterly frequency. So for example, if we wanted to understand what is the impact of the crazy mini budget that we had this week, we wouldn't be able to observe in the data because, well, we're only going to see the data 3 quarters from now where all of the action will already have taken place. So part of our contribution is just what happens in many of our papers in finance and economics, which is to have what? More timely data that will really allow us to capture big news events in a much more timely fashion than before. So this is the new data that we are going to use. And the nice thing or one of the silver linings of Brazil being such a bureaucratic country is that there's lots and lots of data. So the Brazilian Security and Exchange Commission, they requires every single fund to disclosure all of their holdings at the monthly frequency. And this is publicly available on the web. So one of the reasons why I couldn't show you results, that my poor co-author started scrapping their website to create the portfolios, importing to data or whatever he's using to code to publish it, but we couldn't. So we have more than 8,000 equity funds. We have about 7,000 pure fixed income ones and 30,000 that we call multi-asset. They can invest a little bit of everything, hedge funds, equity and fixed income and so on. This starts from January 2002. And well, our scraping just ended in July because we had to stop at some point. Unlike anything in the States, we actually have the daily flows from 2002 onward. So that's what can really allow us to observe money coming from outside the mutual fund world into the mutual fund world on the stock market. And we can use all of those different asset classes. What I'm going to show you in the next 2 or 3 slides is just a hint and a very simplified version of the model that we have in mind. Okay, so rather than having the possibility of investing multiple assets, generate equilibrium, suppose that we are thinking about a fund manager that solves a very simple maximization problem. We want to try to maximize the returns of investing in one stock relative to a benchmark while minimizing the risk. And the benchmark returns are a function of certain risk factors. Suppose, for example, that I only invest in growth companies or high ESG stocks, and that's what this is trying to capture. Okay, of course, subject to our usual budget constraint. So when we do this, we find an optimal risky asset share for asset I that is a function of its exposure to the risk factor, plus something that depends negatively on the coefficient of risk aversion and total volatility. Again, like we always know, if I'm more risk averse or if there's more risk, I want to buy less shares, but increases also with the risk premium. And then if we do market clearing and aggregate across investors, that's where the elasticity that I've been talking since the beginning comes from. And the elasticity is just what? Well, is the derivative of the change in quantities of a certain asset as a function of the change in prices. So this, I guess this is Xi, this is going to be a function of how much we invest in risky stocks. This is going to be a function of the particular individual references. And to estimate those things, that's when we're going to use this new procedure that the authors also are trying to sell. I think they have a paper at the JPE or KJE in which they call granular IV. So the idea here is that because investment in stocks is very concentrated, they show that if we're able to identify exogenous changes in flows for a certain fund, we can decompose and find instruments such that we apply our IV machinery. Okay? And this here hinges on the possibility or on the fact that in financial markets, lots and lots of investors have constrained mandates. They cannot fully adjust the portfolios. So, and that's kind of all, unfortunately, I could present today. I was telling you yesterday, I was working until 5 o'clock in the morning, and my poor co-author in the States as well. But we already have the model in a much more complicated format, multi-asset, and the results are super cool. And now that we finally managed to get the data in shape, the results will come on. So hopefully, if you still invite me for the next research day, then I really promise I'm going to have everything, and I will shock you more by having just a John Lennon quote to show. But I do hope that either the end of the world will come or things will be okay for the project. Thank you.
Pedro, this is a very interesting project. Thank you for presenting. I have a couple of questions. The first one that I'd be interested in is, are there, based on your model, I felt it was a little bit unclear. Are there any implications for asset prices for having this heterogeneity in price elasticities of demand, or are they just averaged out? So how would your setup differ from Gabex and Coin, who, in your view, are estimating sort of an average across all types of investors, sort of price elasticities? And my second question is, will you have data on sort of in foreign investors' holdings of assets in Brazil? Because I think it would be a lot of people talk about how capital flows are an important driver of emerging markets, and will you be able to speak to that in any way?
Mm-hmm. Okay, so here, let me start with the latter comment. So in the original data, but we're still hoping that with time, the Brazilian exchange will be able to give to us, we will literally have everything. So if we have, say, a Goldman Sachs fund coming to Brazil, we're going to have all of their trades. And that was actually our original idea, right? We can try to investigate whether foreign investors, they might be less sensitive to flows, so they might get a premium because of this relative to retail investors and so on. In the new data, what we can actually do is we do have Brazilian funds that invest abroad, so they can report those things. In order to have data from international investors, we would need them to have established the mutual fund in Brazil. So if you are a direct investor in the States and you come to Brazil, then we would have their portfolios. So when I was looking at the data, we do have quite a lot there. We still need to see if we can match non-Brazilian stocks to it, but in theory, we do. So from the point of view of asset pricing implications, there are then a couple of them. One, as I said, could be policy. So knowing how different types of investors react to these shocks can give an idea to regulators of where potentially large negative shocks to stock markets could hurt the most. Suppose, for example, that we have a flight to safety, a flight to liquidity that has the potential to move stock prices a lot. Well, knowing which investor might be more sensitive to begin with might give some ideas and to regulators on how to prevent a market rout that takes place. So just like when we're looking at stochastic discount factors as another way to test asset pricing models, this is a similar idea. Because the difference between the theory implied elasticities are so weird relative to what empirically all of us have found, we need to find ways to justify what we observe in the real world with our models. And that's why Gabe and Coyton came up with this inelastic hypothesis. Okay, so on the theory front, we're just generalizing their model even more. And because we have the granularity in our data, we'll be able to back out some estimates that hopefully will be probably even bigger in magnitude, because we're not going to be averaging things out after 3 months. It'll be like my Liz Truss mini budget example, right? That even though we have had lots of commotion this week, probably in 3 months, things will adjust a lot more than what it seems like today. Okay, and that's it. Thank you again, Daniel, and I hope you recover. Thank you for going through COVID and my presentation.
No worries, thank you.
Great. Any other questions from anybody?
Took this one.
Okay, so maybe this is a little bit irrelevant, but kind of motivated by your model. So I was just thinking about, for example, the risk parity strategy, right? So eventually when you think about you want to invest money, you can maybe just allocate it into different market. Then in that case, when you think about the macro level elasticity and the micro level elasticity, right? So that could be quite different to begin with. But I know that this is only a very particular strategy only using by hedge fund, for example. For pension fund, they are kind of restricted, as you mentioned. Like they can really invest a lot in the stock market, for example.
So there are a bunch of papers now that they also try to measure the elasticities for different risk factors, right? So for example, are size or ESG stocks more or less inelastic than, for example, the general one in the stock market or whatever? And if you think about risk parity, we can also think about the volatility factor, right? We can back out all of those different elasticities that hopefully, that goes back, I think, to Daniel's point, to helping us also to understand a little bit better the characteristics of the underlying assets. So yeah, and that's definitely one of the things that, again, soon we hope to do. Brilliant. Well, thank you. I think there's.
Yes, I've got a question, a bit of a stab in the dark, but what impact could your findings have on the efficient market hypothesis? Because you were framing the narrative in terms of there ought to be a reason why you sell an asset, and somebody expects something out of that transaction.
So here I'll try to quote what Gabe and Cogent they do. So in their paper, they actually have a section which is just usual questions that we get asked. And one of them is exactly this one, right? So what does this have to say about efficient markets? I don't think there's anything here against efficient markets. As we know, out of the many implications of the hypothesis, is that while prices will fully reflect information, okay? But in order for that to happen, remember that we always have the underlying hypothesis of what? The lack of frictions, right? That we can buy and sell freely. In this case, part of the reason why markets can be inelastic is exactly because there are frictions in place. We have due to institutional requirements, investors that might not be able to fully adjust their portfolios if a shock comes. And again, that has nothing to do with information, right? So there is nothing wrong here or anything that would, in my opinion, go against the efficient market hypothesis. It's much more that because of these frictions, we can have an impact just because of this ability to absorb a big flow of money coming in. This can go, think about real estate in London, right? Due to planning regulations, we know that the supply is pretty much what? Fixed, right? So if London now becomes a more global city and we have money coming from abroad, we're competing with everyone in the world to buy a property. So since there's no way in the UK to go up or sideways, at least in London, what happens with prices? They end up going up a lot more. That's kind of the idea.